According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey, our July survey of manufacturing supply managers in the 9 Mid-America states says there's no recession here. The overall index is in solid growth range. Although it's, when you compare it to earlier months, it's still down. We're seeing softer growth than what we saw earlier in the year and what we saw at this time last year. So the overall number moved up, rose to 59.8 from June's 58.6. And again, all these indices range from 0 to 150 being growth neutral. We asked about confidence looking at the economy 6 months ahead. It was still very weak, but up from last month. So things are moving along, not like what we'd like to see, but much better than what we're seeing in some of the national numbers that have come out. Here I'll bring up the graph showing comparing the Creighton regional number, 9 Mid-America states there in blue, and you see it's in solid growth range, down from earlier in the month, and you compare it to last year, well down from last year. There in red, you'll see the national number, which will come out later on this morning. I expect the national number may dip into negative growth territory, in other words, below growth neutral. We'll have to wait and see on that one. But again, the Creighton number in the 9 state regions is well above growth neutral.
What were the hiring trends?
Hiring is very solid. The July number is 58.7. That's down from June's 59.7. But still, that's again a good number. On average, we ask about pay. We ask about what the supply manager's expected pay raise for the next year, 3.5% on average. That's well below the inflation number. Whatever we see, I expect inflation to come down, but not enough to make that positive. In other words, the inflation adjusted pay raise that they're expecting is well in negative territory, but 3.5% in nominal terms. When you look at regional employment still, when you do, now this is non-farm, seasonally adjusted employment, is still, for the 9 states, still below pre-pandemic levels. And in fact, we're negative 1.2 compared to 1.2 percentage points from pre-COVID-19. The U.S. number is down 0.3%, so closer to the pre-pandemic levels for the U.S. and the region. Only South Dakota and Arkansas have employment levels, that's non-farm, season-adjusted employment levels, above pre-pandemic levels.
What inflation trends are you noticing?
Inflation is still well above what we'd like to see. The July number was 82.8, which is down from June's 88.0, so it's down a bit, but still seeing a lot of what I'll call excessive inflationary pressures at the wholesale level. On average, we ask the supply managers about prices for the products that their company produces and sells. They expect a 7.4% on average, 7.4% growth over the next year. Now that's pretty darn good compared to what we've seen when we asked the same question earlier, but 7.4% looking forward for the products they sell. Even so, I do expect inflation to soften in the weeks and months ahead, but I think it's still, the inflation at the national level and in the region is going to remain above 6.5%. That's 3 times what the Fed's target of 2%. So inflation is still a real problem in our survey. It will continue to be a problem at the national level.
What is the economic outlook?
What I'm seeing and what our survey is pointing to is a diversity, I'll call it recession diversity. In other words, the manufacturing sector continues to move along at the national level, not quite as strong as the regional level, but even there, we're not seeing a recession in the manufacturing sector. It's more of other sectors, leisure and hospitality, other sectors where you're seeing numbers well below growth neutral, in fact, negative territory in terms of GDP. Inflation will remain above 6.5% for the rest of Q3 of 2022 and probably only through the rest of the year. In fact, economic growth will slow even for manufacturing. Again, our numbers are still solid. I expect to slow down somewhat from what we're seeing right now. Supply chain disruptions, they were down from this time last month, and we're seeing, I expect supply chain disruptions to ease a bit in the weeks and months ahead. We're going to see short-term interest rates rise not by as much as we expected initially, by another 0.25%. I expect the Federal Reserve to soften on their rate hike. The next rate hike from the Federal Reserve will be in September, and it'll only be 0.25%, if that. So we're seeing on the short end, short-term interest rates, they're going to remain where they are, moving somewhat sideways. And the prime interest rate will move from 5.25, today's 5.25, till about 5.5 in the third quarter of this year. Now, in terms of long-term interest rates, those will begin to move upward. So what we're seeing for those who are following the yield curve is getting very negative. In other words, short-term rates are actually moving ahead of long-term rates, and that's again a big signal of inflation, of a recession in the economy. Now, what you need to watch out for, and this is very important for all of us, to keep an eye on the bond market. The bond market is going to tell us what's likely to go on. What the bond market now, and what I'm really talking about there is keep an eye on the 10-year Treasury. The 10-year Treasury, when it moves up, that's indicating more inflationary pressure. When it moves down, which we've seen recently, this week in fact, last week, we saw that yield move lower, move below 3%, move down. In fact, it's 63 basis points, that's 63 100ths of 1% lower over the last month. So those bond rates are moving lower, which again points to an economic slowdown. Keep an eye also on the employment report, which will come out this Friday. That employment report is likely to be weaker, but still positive jobs added. So the administration's argument that the job market is strong, it is in terms of numbers. There's some real weakness there in terms of productivity growth. Productivity growth in Q1 was over -7%, more than a -7.1%. That's the worst productivity showing since 1947. So although employment is we're seeing additional workers, we're not seeing additional GDP. Keep an eye on the price of a barrel of oil. That is now moving between 95 and 100. That's West Texas crude. If that moves higher, then we're going to have to see the Federal Reserve move to raise interest rates, which will push the likelihood of recession even higher, So even now, as I talk to you today, the recession likelihood is there. We're probably in a recession or skating along and moving into the recession in the next quarter or so. And listen carefully to what the Federal Reserve, governors of the Federal Reserve say. Those are 7 men and women appointed by the president. They're out there and they're going to try to tell us what they see going on, and what they see going on is what the rest of us are likely to see later. And when they see a recession ahead, when they see inflationary pressures ahead, they're going to be raising interest rates. So they're going to be raising interest rates if inflation ticks up more. Right now, it's getting a bit softer. The Fed's moving back, pulling back, and we're seeing less of an assertive or aggressive Federal Reserve in the weeks and months ahead. I think the Federal Reserve is going to take its foot off the brakes. They're not going to put their foot on the gas pedal, but they're definitely going to pull back in terms of the breaking the economy. So right now the Federal Reserve is sort of moving to the sidelines. We'll have to wait and see. Look at the CPI number in August and September. That will tell us a lot about what the Federal Reserve is doing. But right now, the Federal Reserve, in my judgment, is going to move to the sidelines at least over the next few months. And that's it for our survey for the month of July. And until we meet again, may your economic cup runneth over. And thank you for joining in. See you next month.